Why should franchisees take private equity investments? Hello, this is Jonathan Mays, editor-in-chief of Restaurant Business, and in this week's episode of A Deeper Dive, I speak with Mike Esposito, the co-founder of Franchise Equity Partners. Franchise Equity Partners is a private equity firm specializing in franchise businesses, specifically franchisees. Mike helped found the firm in 2021 to invest in all kinds of franchisees. Before that, he had an extensive career in investment banking, working for 20 years with Goldman Sachs. You might have heard of them. He is also a Jersey Mike's franchisee. We talked with Mike about the state of the restaurant business, mergers and acquisitions, and other issues. And the result was an extensive, interesting conversation about what kind of investments work these days and what do not. We talk about the necessity of restaurants value push and the impact it could have on profit margins at the store level. We also talk about what kinds of concepts that have distanced themselves in today's markets and how you can know whether an emerging chain will have legs or not. We also talk about why a private equity investment is good for certain franchisees. It's a wide-ranging discussion on the restaurant business on A Deeper Dive, so please check it out. All right, I'm here with Mike Esposito. Mike, welcome to the podcast.
Thank you. Really looking forward to the discussion.
Awesome. So, all right. So you have an interesting background, and I want you to tell us a little bit about yourself.
Sure. I spent most of my career at Goldman Sachs. I was there for 28 years. I was a partner for 20, and I ran the Global Financial Institutions Group in investment banking. So we worked with banks, insurance companies, asset managers on things like M&A and corporate finance, capital markets, capital raising. And I left in 2020 and very quickly got on to this idea of forming call it a private equity firm focused on franchise investing. We call it Franchise Equity Partners. We're about $1 billion fund. We started about 3 years ago, and we've now made 10 investments. We spent half our $1 billion in 10 investments around the franchise industry. And we do everything from quick service restaurants to auto dealers, to heavy equipment dealers like John Deere, Caterpillar, to beverage distributors, Coca-Cola bottlers, beer distributors, and then other consumer business services, which runs the gamut from Planet Fitness to residential services. It's been great the last 3 or 4 years with the business. I actually got into it because I'm a franchisee personally of Jersey Mike's. I have 5 stores with a partner up in Massachusetts, and we're hopefully going to be on to our 6th. So I have a little, I'm not really good at making sandwiches, but I have a little firsthand experience in the franchise world.
All right, super. You should have led with the Jersey Mike's thing. This audience is full of franchisees, and they love that's an itchy. In fact, how are you're pretty happy with Jersey Mike's at this point? You must be.
Oh, Jersey Mike's is phenomenal. It's a great, great brand. It's got one of the things we look at as a firm is brand momentum, and Jersey Mike's has got it in spades. It's got it because it's got great same-store sales performance. It's got still a lot of white space. The development economics in terms of new builds is still pretty good. So in terms of things we look for economically, it's been great. And I would say culturally, it's a really unique culture. It's all about giving back, and that resonates not only with the customers, but it also resonates with the employees. People love to work there because of this idea of giving back. And so, yeah, it's been a great experience so far.
Yeah. Yeah. I think there are 3 restaurant chains in the United States right now, just 3, that you can legitimately say these are absolutely the next Chipotle. Wingstop, Raising Cane's, and Jersey Mike's is one of them. If you look at consistent growth across both, not just not just with unit growth, anybody can add a bunch of units and then call that success. You got unit growth. You got organic growth on a per unit basis. You have really good unit economics, unit volumes, particularly when you measure them with competitors. And you just sort of see them sort of really distancing themselves with a lot of other comparable concepts. I mean, I think Jersey Mike's is really one of the best, certainly one of the best non-top 10 chain names out there for sure.
Yeah, no, we keep a list of, we call them emerging brands. So you could set like some of them like Wingstop and Jersey Mike's is probably already emerged. We love Raising Cane's. The real problem with Raising Cane's is, as you know, it's a company-owned model, so it's not really franchise. So that's harder to get into. Yeah, exactly. But those three names are definitely on our list of emerging brands. I would say other names that we love are like things like Tropical Smoothie, um, Seven Brews. We love Culver's. There's a bunch of them, but it's those kinds of concepts that have exactly what you described. It's really strong AUVs, good unit economics, real growth, not just coming from price, but actual transaction growth. It's interesting when we look at it, we find a lot of the brands. This actually isn't true for Jersey Mike's, but it's true for most of those other brands. They skew heavily Gen Z. And I think that's another big piece of it. And so a lot of the older legacy brands do not. Like the customer base is getting older and older, and the brand is actually literally dying out. But a lot of those brands you just mentioned share that Gen Z focus. Yeah. As well, they tend to be very digitally enabled.
Right. Yeah. Yeah. I mean, you got to have the kids. You got to be able to attract the kids. That's kind of fundamental to the business. And you mentioned Tropical Smoothie. That was, I think concept doesn't really get the attention I think it deserves either. I could almost put them on that list as well. That was a fantastic deal, that Tropical Smoothie deal.
The Blackstone
that's
deal.
Going to be interesting.
Yeah, I mean, you're right. It's not a category. We put it rightly or wrongly, we put it in a snack category, which in fairness to Tropical Smoothie, one of the things they do really well is they actually have sandwiches and things that broaden out the day parts. But yeah, it's a category that doesn't get a lot of attention, and it's actually a really, really hot concept.
Yeah. Yeah. So now, my question is so you invest in QSR concepts. Are you buying?
So we're buying for sure. But I think we've been really picky in the last 18 months. And I don't think we're alone in this, quite frankly. And I think there's probably two or three things that are driving that. First and foremost, same store comps are really difficult in this environment. Inflation has gotten the better of the consumer. And people have probably just taken too much price in this environment. We had such commodity shortages over the last couple of years that concepts took a ton of price to make up for that gross margin pressure they experienced. But now we've had commodity deflation in the last 6 months, and nobody's really given back price. Now we're starting to see the emergence of that with value meals. The concern is that I think that's good. I think it's necessary, and hopefully it starts to drive traffic. There hasn't been a lot of green shoots that we've seen yet on that. But the concern is ultimately that becomes a price war. And again, we haven't seen that either, but that's where that could go. But one big issue in terms of this current investing environment is that the lack of same store sales growth just changes your view on future cash flows. Number two, interest rates are up a lot. And so when a lot of activity in the private equity world focused on restaurants was occurring in the 2019, 20, 21 period, it was one of those industries that did really well during COVID. It was being priced with interest rates, basically at zero. And now with credit spreads and all, interest rates have more than doubled. And that affects what people can pay. And so what we've seen over the last 18 months certainly has been sellers still holding on to the multiples at which they entered the business, and buyers repricing for the lack of growth that's no longer there and the higher cost of capital. And so we look at a lot of things, and we would like to get more weighted into restaurants, but it's just been tough finding prices that work for buyers and sellers. And I don't think we're alone in that, because when you look at it over the last 18 months, there's been less restaurant M&A activity than we've seen in a long time. Hopefully that's going to turn, but we don't yet see it quite turning.
Yeah. Yeah. Well, I mean, from my perspective, the only things that get done or have gotten done really the past couple of years are super good brands. Tropical Smoothie being probably a good example of this. Really, really good brands that can go in any market. Historically, as any good a really good name can go in any market. And so those you get those names, and then you got the problems. And so there are all these low end buyers out there. And so everything else in between is still sort of an iffy market. Though I keep hearing people keep telling me that things are going to warm up over time.
Yeah, I think you also have to distinguish between the market, the merger market for
Yeah.
franchisors and franchisees. Franchise, the tropical smoothie deal that Blackstone did was an investment or acquisition of the
Hmm.
franchisor.
Right.
And, that's different, because of some of the inherent conflicts between franchisees and franchisors. And so we have seen some larger deals get done with franchisors. In addition to tropical smoothie, obviously the other big deal that was done last year was Subway. So there are some larger things happening. But I would say in the franchisee space, which is where we focus, cost of capital matters a lot because that is the capital intensive piece of the business. And, the building out of franchise systems is on the back of the franchisees. Franchisors run a fairly capital light model. So as a result, people are really sensitive to increased interest rates. And I think, again, that's why you've seen this kind of slow down.
Right. Yeah. Yeah. So if you, to broaden it out even further, like there is a wide gap in M&A activity between franchisors, and companies that operate stores. Because to me, like if you're operating stores, whether you're a franchisee or a company operated model, it's a tougher market overall.
And it reflects itself in the multiples. I mean, if you look at where like Yum, RBI, and McDonald's, right, three of the largest market cap franchisors trade in the public market, they all trade in the low 20 times earnings. If you look where franchisees trade in any of those systems, depending on a specific concept, they probably trade 6 to 9 times. So, part of what we like about being a franchisee is that it's a lower entry point in terms of multiples and therefore generates a much better cash on cash return profile. And so a lot of private equity focus exclusively on the franchisor world, but we really like this franchisee space because of the great unit economics and returns on capital in a cash on cash kind of world.
Don't you get concerned though? Because when you were talking earlier. I mean, you mentioned that we didn't really see restaurants give back a lot of price until relatively recently with some of the value offers that are out there. Aren't you concerned a little bit though about the impact that this value push? Because my sense of things is that we're in for a value push for an extended period of time, probably. I mean, McDonald's reported earnings this morning, and their top line was awful. I mean, they're clearly declining traffic. McDonald's reached its, well that there is this pricing limit. McDonald's reached it and then broached it, and now customers are telling them, nope. And now they're facing months and months and months of essentially a correction. The fact is, franchisees are the ones that end up having to pay for that because they're the ones that are going to basically have to donate their margin, which is essentially what McDonald's is saying this morning. They believe that McDonald's franchisees have the profit margins to be able to invest, quote unquote, into these value initiatives. But then that also hurts, the profit margins of the franchisees that you invest in. Does that just give you some cause for concern?
Yeah, it certainly does. So I would say a couple of things. I think that there's no doubt that people need to take less price in this environment and hopefully take no price and give some back to the consumers through value pricing. And I'd like to think that will lead, like basic microeconomics 101 would suggest that should lead to higher traffic. As I said, we haven't quite seen that yet, but I'm optimistic if it's prolonged for a prolonged period of time, it'll be beneficial. And I would argue that franchisees are pretty profitable and the margin structure today is good and they can afford to give a little bit back. Now, that said, I think, again, when you think about these inherent conflicts between franchisor and franchisee, I think the franchisors ought to have a little skin in the game on this too. And McDonald's actually has done this. So for example, McDonald's negotiated a deal, I believe it was either Coke or Pepsi, I believe it was Coke, but I might be wrong on that, where they got the soft drink manufacturer to contribute in some money, like real money. And McDonald's negotiated that. And I think McDonald's may have put in some more money into the ad kitty. But they certainly did with the soft drink provider. And so, at the end of the day, it can't just be about beating up the franchisee to reduce price, because some of it ought to be on the back of the franchisor too. So I think there's room to give back some price. I think they have enough margin that people can do it. I think it should be done in a way that's aligned with the franchisor, and the franchisor is also contributing to it. I think the tipping point is, if there's ultimately going to be a price war. And, McDonald's has been out there very aggressively with this $5 value meal. Wendy's has matched it. Taco Bell has their own version. A number of the concepts have it. And I don't feel like we're there yet, but it could be a race to the bottom, particularly if the consumer remains weak.
Mm-hmm. Yeah.
A lot of it, by the way, is also going to depend on what happens in the macro economy, because, despite somewhat of a slowdown, despite consumers starting to borrow more, the economy still feels really, really strong. And I'd like to think that the Fed's going to navigate a soft landing and start to move to a lower interest rate posture. But if that doesn't go right, that'll obviously unsettle things quite a bit.
Right. But so first off, one thing I'll say is, if franchisees, unless you happen to be in California, which is an exception, don't take price this year. You don't. Like, I can tell you in no uncertain terms, like, brands that have held the line on prices are doing better than those that have not.
Absolutely.
You have to take some, you had to do it the past couple of years, but those that were more conservative on price generally tend to be doing better than others. Consumers do notice this stuff. But, the thing about the economy, the interesting thing about the economy, look at the three companies that have reported earnings so far. I find this fascinating. Chipotle last week does an 11% comp. On no planet should Chipotle have done an 11% comp last quarter, with everybody screaming about their portion sizes. What the heck? I will never understand that. But anyway, they do an 11% comp. Texas Roadhouse does a 9.3% comp. Now, Texas Roadhouse probably a unicorn. And then McDonald's does a negative 0.7. To me, the economy for much of the consumer base is fine, right? On balance, they have jobs, things are expensive and but they're still really prefer eating out. And for a large part of the consumer base, it's fine. They're frustrated by McDonald's prices for sure, but it's really that lower income consumer that's kind of the tough one. And those companies that over-index to that consumer are the ones that are more likely to see these sorts of challenges right now.
Yeah. Yeah, no, I agree. The value consumer, when you look at the concepts that are more dependent on value consumer and old line, and it's mostly for the most part, it's the old legacy tier one brands. Yeah, those are the most challenged right now, for sure. Yeah, that's the other thing that we find interesting about the structure of the restaurant industry. If you look at each of the major categories, so, pizza, chicken, burgers, they're each dominated by a player that controls basically 50% of the market. And those brands, McDonald's, Chick-fil-A, Starbucks and coffee, those brands, they have their issues right now. It's not as good as it used to be, but those brands are pretty strong, and they are setting everything in terms of price. They're setting everything in terms of ad spend. They're setting everything in terms of delivery mix and product selection and innovation. It's good to be one of those brands. And then you have in each of these categories these emerging brands. You can pick whoever you want, but in chicken you mentioned Raising Cane, Slim Chicken would be another one. In burgers, I don't know, maybe Whataburger, In-N-Out, and so you have these emerging brands that are taking share, and then everybody else is getting squeezed, and it's really a tough spot to be. For those kind of those legacy tier one brands that are kind of caught as the number 2, 3, 4, 5 player. Those are the ones that are really challenging right now.
Mm-hmm. So let's shift gears here a second. Actually, let me say this. Like, in a market like this, as you as an investor in these brands, and you said you were picky. So how do you go about making those investment decisions in a market like this? What kind of brands do you look for? What are you specifically looking for before you make a deal like that?
Yeah. So, our thing, let me answer it like from the lens of a typical private equity person. And then let me add on one thing, which is unique to us. So, we tend to be we don't like to do turnarounds. We like to buy good companies, even if you have to pay more in terms of multiple, that are showing really good performance. One of the other things we haven't talked about, in addition to the need to have good same-store sales performance, particularly driven by transaction growth, one of the things we haven't talked about is margin structure. And one of the challenges about franchise restaurant investing is the margin structure is tough. And if you think about it, that if you look at the store level margins, we definitely want to look at places that are greater than 15% store level margins. And the reason for that is that because of some of the challenges we just talked about, more margin just means you can be insulated from more problems. And we find that most companies have 3 to 4 to 5 to 6 points of G&A above the store level. And so if you start with a 12% margin, you've got 5 points of G&A at corporate, and you're at a 7% margin. It doesn't take a lot to get you upside down. And so, we really look a lot for brand momentum, margin structure at the store level, white space. And as a result, we do like some of these emerging brands that we talked about and we're willing to pay up for. And I think to me, it's always challenging to price some of these deals as a value investor and convince yourself you're buying it cheaply enough for situations where they don't have great margin structure at the store level and to a lesser extent, same-store sales growth. The thing that's unique about us and the thing that makes us different than most private equity firms is our whole philosophy is to have a style we call minority, passive, and permanent. So we take a minority equity stake, typically 20 to 40% alongside of the owner operator. We're passive. And so the whole idea is the owner operator's got more skin in the game, i.e. more ownership than us. And we don't consider ourselves operators. And we're permanent. We can invest for a long, long period of time, minority, passive, and permanent. So the other thing that's extremely important for us is the operator. And again, we don't really want to invest in turnaround situations. We want best-in-class operators who want to partner, who want to stay massively invested in their business and want to continue to grow. And those are the types of people. And so I would say that's different than a lot of private equity firms, in terms of what we look for in our deals.
So you like looking at emerging concepts. How do you know? I mean, I guess it probably depends on your definition of emerging concepts, but I look at emerging concepts in the franchising space. And I always tend to think that that's a more risky deal, than, even if you invest in Burger King and, or some of these more weaker legacy brands. I mean, for the most part, these brands aren't going away. But, if I had a lot of these emerging brands might do really, really well today. And, I'll tell you, there is one brand that a lot of people, that were, like Mod Pizza, for instance, have significant issues. So brands that may on the surface look like a successful concept ultimately turned out not to be, and then they end up having major problems. Like, how do you determine whether an emerging brand, because you like the beverage space, for instance, we got a lot of very rapid growth there. How do you know that an emerging concept has legs to be a long-term investment?
Yeah, no, that's a really good question. And, you don't. So how do you minimize that risk? And obviously anything you do is you've got risk. And to your point, you've seen some brands do well, then taper off as they get bigger. And I would say like one big qualifying theme is, does the brand work outside of its home base? Because you've seen a number of concepts that have done really, really well in a home base, Texas or the South. And when that brand then tried to scale nationally, they just didn't work. The concept, for whatever reason, didn't work. And so for us, we like to write $50 to $100 million equity checks. So we're going to be focused ideally on operators that have probably north of 75 stores. And so for us, it's probably concepts that have certainly north of 500 stores in them. Might we do something in a really small hyper growth concept that's got 50 stores? Maybe. We are definitely not venture capital investors. We look for very consistent returning investments. So when I talk about the desire to invest in emerging concepts, you take Jersey Mike's or Wingstop, those for us would be the sweet spot. And again, you could argue very easily they've completely emerged. But they're, north of 2,000 stores in their case. And so to us, that's a really great spot, but down to 500 stores. So like, we're not going to take the scaling risk of, I don't know I forget what Mod Pizza has now, but
more than 500.
I guess does it have that many? Huh. Yeah.
Yeah.
Well, not to pick on them. I haven't really looked closely at Mod other than being a customer once. So not to pick on them. But yeah, I think we were going to want relatively robust systems and not take that scaling risk when people are going from like 0 to 500 stores.
Yeah. They won't have more than 500 stores for long. But I mean, that's probably a little bit more of an extreme example. But we've had brands that have gotten rather large, very fast. Anyway, this is a question I really want to get to before the end of it. So, say if I'm one of these big franchisees, why should I take private equity? Why should I take your money rather than, go into debt?
Yeah. Well, I think it's a good question, and it's not something that anyone should take lightly, because when we come into a company, for the most part, we're their first outside investor ever. And we invest oftentimes, usually almost always with families. And like the idea of bringing in somebody is not easy. I think, investors differ. And so our whole thing about being a minority passive and permanent is highly unique. And for somebody who doesn't want just cash out, that's a unique proposition. You stay in control. You, Mr. Franchisee, you stay in control. And so I think, one element of this is how much control do you really need to cede? And we really leave all day-to-day control in the partner. Number two, I think there is some, call it investor discipline, that's probably healthy for any company. As companies are scaling and becoming bigger and becoming less family-oriented, having an outside investor to kind of look at the company, ask the hard questions is important. And so I think that's the second piece. And then the third piece is, find a partner that can actually add value. And I always say, I don't want to sound like I'm talking out of both sides of my mouth on this. Like, we're not going to tell an operator how to run their company, but we've got a lot of things we bring to the table. For example, we've got a guy who does all of our capital markets work. And so anytime one of our companies wants to raise debt, he does it. He spent his whole career in the banking industry. He knows every bank well. He knows the terms and negotiating the covenants. And so we get really good bank deals for our companies. Number two, we've got a data science effort. So we are literally scraping minute by minute the pricing for 20 different restaurant concepts nationally. So if I operate a concept stores in North Carolina, we can tell you in the North Carolina market or in your own market how you're priced your tacos, your burger, whatever, relative to everybody else. And we can do it not only for your same system, like not just for the Burger King operator. We can tell you where McDonald's is pricing and where, Wendy's is pricing, et cetera, et cetera, et cetera. We have white store analytics that we can bring to bear. So where do you want to put your next flag, your dot on the map? We've got data science that we can address that. We build dashboards for our company. So if somebody wants to get better KPIs and insights in their business. So find a partner that can add value. Our capital markets expertise, our data science efforts are just two of the ways we can add value to our companies.
Mm-hmm. Super. Mike, this was wonderful. Really appreciate you joining me on the podcast.
Thanks, John. I really appreciate it. It was great talking to you and look forward to seeing you in the near future.
And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Spoons, artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. And you may subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening.